In today's video, we're going to talk about 11 nasty state estate taxes that you may need to consider if you live in one of these states. Now, a lot of retirees think that estate taxes are just something that the uber wealthy has to deal with. But as we'll show in this video, there are a lot more retirees that will need to be calculating and layering on this complex tax hurdle if they live in one of these states. Let's get into it. Now, it's easy to see why a lot of retirees think that estate taxes are just something that the uber wealthy has to deal with. If we look at the federal estate tax exemption, it's quite high. In 2022, it's at $12.06 million, meaning that if you have an estate less than that, you really don't have to worry about estate taxes at the federal level. And estate taxes at the federal level have something called portability. Now, this term will come up again a little bit later in this presentation, but essentially what this means in layman's terms is that the exemption is handled at the individual level if you handle your estate situation properly, meaning that both you and your spouse have that given exemption level. So really, your estate tax exemption, if you are married, can be as high as $24 million. Now, two things to keep in mind at the federal level. First, as part of the Tax Cuts and Jobs Act, the federal estate tax exemption will be dropping back down in 2026. Also, keep in mind that Congress can change this federal estate tax exemption at any time. You can see with the graph on the screen that past exemption levels were far smaller than they are today. And so keep in mind that this might not be something we need to consider right now, but that can change as we move forward into your retirement. But even though many of us may not need to worry about the federal estate tax, state estate taxes are completely different. These exemption levels happen at far smaller amounts. So here are two states that have an exemption level of just $1 million. So Massachusetts is a big one and was one of the least tax-friendly states in terms of the estate tax. Now, with most of these states, these estate taxes will be on a progressive system, meaning the larger the estate that you have, the higher you will be pushed up into various estate tax brackets, just like we are with the federal income tax brackets. So with each of these given states, I'm going to give the exemption level, I'm going to give the estate tax range, and then I'm also going to give some interesting details around some ripples in the estate tax code of this given state. So one thing that's interesting with Massachusetts is the tax will apply to the whole estate once you're over $1 million in value. So for instance, if you're at $950,000 in estate tax level, you will not be subject to any estate tax. But if you go over that exemption level and you have $1.2 million as an estate, well then the whole $1.2 million will be taxed at those estate rates. In most other states, the exemption level is essentially a deduction, a standard deduction if you will, where below that given level, you won't see estate taxes at all. Oregon also has a $1 million exemption limit. Now, their estate taxes are quite a bit higher, starting at 10% and rising all the way up to 16%. Now, this current exemption does not adjust to inflation, and we'll see this with a few different states. So understand that with these states, the only way that exemption level changes is if the state legislature decides to change it, essentially. And so we need to be planning for some inflation adjustments and some states that don't have those given inflation adjustments as well. Now, a big question a lot of retirees watching this video will have is how will we know if we're at risk of hitting some of these levels as we plan towards the end of our retirement? Well, this comes back to how you build your retirement plan. So if you're building your retirement plan under just one return trial, as soon as you build that plan, it's almost guaranteed to be wrong. We can't predict what next year's market returns look like, let alone the next 10, 20, 30 years. So we often talk about that you should be simulating market environments, looking at great market return trials as well as poor market return trials. And with that, we'll see your level of risk, your probability of hitting some of these state estate tax levels. So for instance, as we run that Monte Carlo and we see these simulations moving through time, we can start to see the probability that you have, which might be in someone's case 40% likelihood of hitting those given state estate levels. That might be something where we now want to start building in some planning to avoid that higher probability of hitting those given levels and trying to avoid that estate tax. Let's move on to another pair of states with fairly low exemption levels. We have Rhode Island here and Washington. Now, Rhode Island has an exemption level of about 1.7 million. And keep in mind that I'm doing a lot of rounding with each of these levels, so they're not exact here. But the estate tax rates range from 0.8% up to 16%. And the interesting detail here is the tax exemption level is not portable between spouses, meaning that regardless of if you're married, you still have that same $1.7 million exemption level. Now, some states will have portability, other states will not have that portability. And again, that's a very important detail to be considering with these various states. We also have Washington here with $2.2 million of an exemption level, and the estate tax rates start quite a bit higher, from 10 to 20% as those given rates as you scale above that exemption level. Now, from an interesting detail standpoint, this interesting detail really isn't only with Washington, it's actually with the majority of these states, that they do not assess a state gift tax. They only are subject to federal gift tax rules. And so this can be an important detail to deal with some of these state estate tax limits. Gift before you pass away. Now, some states have a gift clawback, and we'll talk about what some of those states are here in a second. But let's bring up another important layer onto this estate tax discussion that a lot of retirees may not be thinking about, and that's the nasty double taxation effect that we may see within your situation depending on how you are passing on your given retirement accounts. So let's take an individual that has a very large traditional IRA that they're passing away with. And let's say with this very large traditional IRA, that was really the majority of their given assets. Now, we're not going to dive into very specific amounts and showing given taxes based on those specific amounts, but let's just use some generalities here. So let's say with this large estate, this retiree has an estate tax bill of $250,000. Well, if we think about that, that $250,000 has to be paid from somewhere. Well, if somebody has all or majority of their money in a traditional IRA that they're passing on to the next generation, well, as we pull that $250,000, guess what? There's going to be tax owed on that $250,000. And so this estate tax can create a double taxation depending on those given accounts. Now, when these beneficiaries pull that $250,000 or the estate pulls that $250,000 to pay to the respective government, they're going to owe a tax rate on that. Well, let's just say their effective tax rate is 24%. They're going to need to pull almost $329,000 to pay that $250,000 tax bill. And so this double taxation can really weigh down on how much of an effect that estate tax has on your situation. Let's move on to a pair of states in the Midwest that once again have some pretty nasty estate taxes. Minnesota is a big one, our neighbor state here in Wisconsin. They have a $3 million exemption level and once again have some pretty aggressive starting rates. So once you go over that $3 million limit, you're immediately taxed at 13% with everything over that $3 million exemption limit. And then it obviously scales to 16% in that progressive tax system. Illinois has a $4 million exemption limit with progressive rates from 0.8% all the way up to 20%. Now, this exemption, once again, is not adjusted for inflation. And so that's an important thing that we need to be thinking about and looking into history at how often they adjust, if at all, that given exemption limit. If we're not adjusting to inflation as we see higher inflation like we're seeing right now, well, obviously we should see asset growth corresponding over the following years. But if we're not adjusting that exemption limit to inflation, that starts to become an important thing that we need to be considering. Let's talk about three more states on the East Coast. So we have Vermont, Maryland, and Maine. Now, Vermont has a $5 million exemption level and has a flat tax over that amount. So any estate over that amount simply has a 16% flat tax. And keep in mind here that any gifts within the last 2 years of your passing are included back within your state. Some states have these clawbacks for gifts to make sure they're included so someone isn't gifting away their entire estate to stay below that exemption limit right before they pass away. We then have Maryland with a $5 million exemption level, 0.8% to 10% in terms of the progressive rates that you would see over that exemption level. And this exemption is portable, but Maryland also has an inheritance tax. And keep in mind, we're not diving too much into inheritance taxes within this video. An estate tax is something that's paid by your estate before it passes to the next generation. An inheritance tax is something that the next generation pays. Now, typically, the closer you are to that heir, the lower the inheritance tax will be. The further away you are, let's say a sibling or even a friend, the higher that inheritance tax will be. But keep in mind that Maryland has both the estate as well as inheritance tax. And then we have Maine. With Maine, we don't really have any important details or interesting details that you need to note. The exemption level is $5.5 million, with estate taxes ranging from 8 to 12%. Then with the last two states, we have two states that are fairly far apart here, with New York as well as Hawaii. New York has a $6.1 million exemption level, and then estate taxes ranging from 3 up to 16%. Hawaii has a $5.5 million exemption level with some very high starting rates once again. You start immediately at 10%, and that scales to 20% relatively quickly based on the assets that you have above that exemption level. So if you live in one of these states and are at risk of getting hit yet again by another tax, is there anything that you can do about it? And of course there is. There's almost something you can do about every hurdle that you have in retirement. Now here are 4 quick strategies to deal with some of these state estate taxes. The first one is pretty obvious. You can move and relocate. Now make sure that you fully establish tax residency in that new state that no longer has those estate taxes. And if you have a home in 2 different states, make sure that you talk to an experienced professional like an attorney to make sure that you establish residency in the proper states. The second strategy is spend and enjoy the wealth that you've worked so hard to accumulate, especially if you're in one of those states that once you move over that exemption level, you have your full estate tax, like Massachusetts. If you're just over that $1 million exemption level, you want to do everything you can to lower your assets below that given level, because keep in mind that if you show just $1 over that exemption level, now your entire estate is included and is now taxed under those estate tax levels. Strategy number 4 is strategic gifts prior to your passing. And so we see in this video there is a gap between the state estate exemption levels and the federal estate exemption levels. And so within that gap, you can gift quite a bit before hitting that federal level, but still avoiding the state level. And so strategic gifting prior to your passing can be a fantastic way, even if you gift more than the gift exemption of $16,000 in 2022, you can often gift a lot more using the lifetime exclusion limit from the federal level and stay below that state estate limit to be able to completely avoid that estate tax altogether. Now, as you'll see from this video, for a subset of retirees, estate tax planning is just as important as retirement tax planning. In fact, they're very interlinked. And so this leads to other reasons where we may want to perform Roth conversions as we try to avoid that double taxation zone from pulling estate taxes from traditional IRAs. In addition to this, here are 3 more unconventional estate planning strategies that you can use to avoid taxes at the end of your retirement plan. Thanks for watching, and let us know if you have any comments in the comments below. Always remember, you don't need more money, you need a better plan.